Let's rock and roll. Hi, I'm James Nelson, Vice Chairman at Cushman & Wakefield, and I'm here to bring you the Nelson Report's December 2016 video exclusive. I'm here with Victor Calanog, who's Chief Economist of Reis. Welcome, Victor.
Thanks for having me, James.
Great. So our audience would love to hear what you have to say about the new election results. Clearly, a lot of people are talking about it, a lot of financial volatility in the markets. Is it mostly out of the way now, or what should we expect?
At least from the last couple of weeks or so, the downside appears to be out of the way, right? Right before there was confirmation about whether or not Trump or Clinton was going to win, when it looked like Trump was going to win, the Dow was down 800, 900 points, and then it recovered to minus 100 in terms of the Dow futures just right before the markets opened. Lo and behold, the markets were up basically the next 4, 5, 6, 7, 8 trading days. Have you looked at your portfolio recently?
Yes.
We should be pretty thankful,
yes,
right?
We should be thankful. Now, it was a good Thanksgiving. Yes.
I think what's interesting is that the markets appear to be taking a bet on greater economic activity resulting from things like infrastructure investments. There's a $1 trillion package out there. Whether or not it's going to be financed using public funds or private funds, we don't know yet. That will tend to stimulate more economic activity, which is why the stock of companies like Caterpillar and construction services really rose by anywhere from 7 to 20% right when Trump was elected. So that seems to be a fillip for economic activity. And then the question is whether or not inflation will come at its heels, which is why really the 10-year treasuries have been rising quite a bit as well.
Absolutely. So definitely an impact there in the financial markets, but now looking to what it means for property values, especially here in New York where most of the audience is, it would seem to us that surprises in the marketplace, whether it was Brexit or whether it was China's overall economy, it doesn't seem to have that much of a correlation, nor does the party in power. So what type of impact do you think it actually has on the real estate market here?
It's really very interesting that you mentioned that. I was out there basically saying that Brexit would be a non-event for commercial property fundamentals as well as pricing in the United States. But we also need to remember that we are in a somewhat privileged position as the United States. We are perceived to be the safe haven on a risk-adjusted basis. Sure, our economy has only grown by 2.1% since the end of the recession, since mid-2009, but on a risk-adjusted basis, given how other countries are stumbling, are growing less slowly, and are actually in negative growth mode with negative interest rates, our 2% growth rate economy seems to be a great bet, and superstar cities with real estate like places in New York and San Francisco are reaping a lot of those benefits given that they're real assets that are generating income. So that's the overall context as to why a lot of the geopolitical upheavals that are having an effect on other countries, I mean, Brexit will have a serious effect on the EU, are kind of largely leaving us unaffected. Now, the question has been raised, will a president that has a background in commercial real estate be good for commercial real estate? And I think it seems to be leaning that way, at least in terms of where investors are placing bets. If there are deals to be had out there, people are kind of waiting for more preferential tax treatments if tax policies change. We don't believe that we will see the end to 1031 exchanges, so that's going to benefit a lot of real estate investments. Again, it's not going to lift all boats, but a place like New York and San Francisco will likely benefit disproportionately.
Absolutely. You brought up a couple good points, and foreign investment has been so important, especially here in New York, where last year it could have been as high as a third of all really institutional type investments from overseas. So with kind of an unknown as far as foreign policy, do you think that foreign interest in New York continues?
Again, in relative terms, I suspect that if there are benefits to be had, if the economy keeps growing, if treasury rates don't spike to 4 to 5% levels where the risk-free rate is just more attractive than riskier options, I suspect that any kind of foreign policy change and or roiling of the waters when it comes to how the U.S. relates with the EU and other trading partners, a lot of that will probably redound more to New York's benefit as opposed to its disadvantage. I mean, take a look at Brexit, for example. If there's any kind of effect on Brexit on the property markets, it's probably to basically render London as a safe haven for foreign investment as less of an option. Where else would that kind of money go? New York or San Francisco. Again, if everything else is on the up and up, then New York will probably benefit disproportionately.
That's great to hear. And we definitely have been witnessing a slowdown in sales here in New York City in 2016. Volume is off about 25% overall. That being said, we're still on pace to have probably the fourth most sales recorded
it's all relative,
to date.
right?
So
exactly.
yeah, comparing it to last year, certainly. But
we had a high water mark last year.
Yes.
It's down from last year.
Yes.
But still, compared to 2007 or so, it's relatively healthy, right?
Yes.
Yeah.
But we would think that this decline was really a result of a lot of uncertainty. So, and how much of that uncertainty had to do with the election as opposed to other unknowns, and that could be what's going on over in Europe with the economy. But with the election now, at least decided at this point, do we think that maybe some of these investors who've been on the sidelines, maybe now thinking that they're going to get better tax treatment? In fact, we speak to some investors who say, do you have any clients who want to close before year end? And what our clients are telling us is quite the opposite. We'd rather wait till next year to sell because we'll get better tax treatment. So how do you look at that piece to it?
James, I think the key word here is a definitive roadmap of where the rules lie. In other words, before the November elections, we weren't sure whether a Clinton or a Trump administration would benefit or harm investments, real estate, the climate in general. Now that we have at least that certainty that Trump is in office, that this administration is going to lean this way or that, what people are waiting for will be what kind of changes to rules, regulations, investment decisions, and so on and so forth need to be considered before we make that commitment. And I think a lot of folks are still waiting on the sidelines to make sure that they are familiar with said rules. That will probably happen at or around January when all of these administrative changes are probably rolled out in a more definitive way. Now, with that said, uncertainty is still roiling the markets that are out there, right? Because number one, I think there's that inflationary bet on greater economic activity, and to the extent that there isn't a consistent policy platform that the Trump administration wants to follow through on, there isn't anything that they could do till January anyway. The rules are still up in the air, which is probably why you're getting that advice to wait and see. Not much further than January or February, but I suspect we'll see a burst of economic activity start of next year, and let's see how 2017 pans out.
That makes a lot of sense. Now, talking about interest rates, and we have seen that the 10-year Treasury up 77 basis points in the last 2 or 3 months. Looking at an environment today where back in 06-07 we had the same 3 or 4% cap rates, but it seemed like investors were willing to take on negative leverage. That has not been my experience this go around, is that investors want at least neutral or positive leverage. So what impact, if the 10-year Treasury is up, what impact is that going to have on pricing?
Again, if the 10-year Treasury rate rises past a certain level, then you will see greater upward pressure on cap rates and therefore possibly lower valuations. But spreads are still relatively healthy and or blown out depending on the markets that you're looking at. If you look at the best deals that are out there, or at least the priciest deals in New York, sure, you're looking at maybe even a sub 3 cap rate once you include renovations after the first year or so. But 4-5% sounds low till you consider the fact that we were coming from a 1.8, 1.9% 10-year Treasury before that. So a 77, 80 basis point rise in 10-year Treasuries doesn't worry me as much. On the other hand, if 10-year Treasuries climb to the 4 to 5% levels, then you're looking at basically an investment comparison where you've got a 4 to 5% sure thing versus riskier alternatives like equities, which might return 7 to 8%, or commercial real estate, which if you're trading at 5 or 6% or so, you're looking at razor thin spread, just like what we saw in 2007 or so. Again, I'm not worried right now, but at the same time, November 9 really pushed 10-year Treasuries in a way that the Federal Reserve really couldn't do for 2 years,
yes.
right?
Yes.
It ended QE3. It raised overnight borrowing rates in December of 2014. It threatened to raise it again next month, December 2015. No real blip in interest rates until November 9. So here we are.
Absolutely. Well, definitely something to watch. And the last piece of that, really talking about the impact on development, construction financing. So here it might not be so much an issue of getting the right rate, but really getting the loan in the first place, getting the right leverage. So do we think that maybe Trump's election might ease a lot of the restrictions, the regulations to these larger banks? I've heard that they've really been penalized for making construction loans. Again, this might be a very micro topic when you consider the whole, but the overall development market is down substantially. In fact, land sale volume is down 55% citywide and a staggering 72% in Manhattan. That's a steep decline. We really believe it's a result of not having that construction financing available. So any hope that that could loosen up in the months to come?
It does look like the Trump administration is leaning towards less of a regulatory burden, not just for real estate companies, but for banks in general. So it has yet to be seen what kind of impact January will have on changes to regulatory burdens like HVCRE and a lot of these topics that construction financing folks are worried about. Again, I think the buzzword is, will the Trump administration provide us with that definitive roadmap on which we can hang our hats, whether it means we're writing checks to finance new development or banking on not just short-term interest rate movements, but shovels in the ground 2 years from now, 300,000, 1 million square foot office building that won't see the light of day till 2019, right? And so if we have that definitive roadmap, we will feel a little bit more confident about writing that check. If not, we'll probably hold back. So we will see.
Well, let's all hope for the best. Well, thank you again, Victor. We really appreciate your sharing your thoughts with our audience, and we look forward to the months to come.
James, I look forward to it too. Take care.
Have a happy new year.
Bye.
Yeah, thank you.